All right, this is an example of a Dupont breakdown or Dupont analysis for our two companies, Kroger and Tiffany. I'm going to first remind you what Dupont analysis is. It's a way of breaking down the shareholders' earnings, the net income per dollar of equity, the return on equity, into three component pieces. And the three component pieces measure profitability, efficiency, and financial leverage. The net profit margin is net income over sales. The total asset turnover is sales over assets. If you multiplied net income over sales times sales over assets, note that the sales cancel each other out. You have net income over assets, which is the return on assets ratio. If you take the net income over assets or the return on assets and then multiply it by the equity multiplier, assets per dollar of equity, that gives you the return on equity, net income per dollar of shareholder supplied funds. Okay, so the breakdown is intended to measure how you got to return on equity by looking at separately at profitability, efficiency, and financial leverage. Now, profitability is how much you make per dollar of sales. Efficiency, the total asset turnover is measured, and how many dollars of sales you generated per dollar of assets. The more sales you can generate with the same dollars of assets, the more efficient you are. And then the last one, financial leverage, that's assets per dollar of equity. Now, assets are funded with debt and equity, or total liabilities and equity. So this measures how much, relatively how much of the assets were funded with equity. Now, if a firm had no debt, the assets per dollar of equity would be 1. It'd be assets are equal to $0 of debt plus $1 of equity. Then you'd have an equity multiplier of 1. But most firms have some level of liabilities. The larger the financial leverage, the riskier the firm, but that's not necessarily a bad thing. All right, so let's look at the Dupont analysis here for Kroger and Tiffany. The first one I'll do, net income per dollar of sales. And we get 1.6%. Copy that over. And we'll copy the same for Tiffany's. Notice Tiffany has a much higher net profit margin. Net income per dollar of sales is much higher. All right, let's look at the sales they generate per dollar of assets. The total asset turnover is much higher for Kroger than it is for Tiffany. So Kroger is much more efficient at generating sales with its asset base. If I multiply these two numbers together, I've got the return on assets, and it's about 5% for most years for Kroger, and it's a little over that most years for Tiffany. All right, now we get to the equity multiplier. That's the assets per dollar of equity. And we see Kroger doesn't have a lot of equity relative to its assets, but Tiffany's does. So the Tiffany's assets per dollar of equity is much lower than the Kroger's. So when we multiply the return on assets times the equity multiplier, we can see that for every dollar that the shareholders provide to Kroger, Kroger earns 20 some odd cents for every dollar every year, okay? And some years it's materially higher. They had one bad year here in the middle. With Tiffany's, it's closer to 10%, all right? This is their really good year, 16.7 for the year ended January 2014. Kroger's almost twice that. All right, so the shareholders are earning a higher rate of return for every dollar they invest in Kroger's relative to every dollar invested in Tiffany's. Tiffany's makes more for every dollar of sales for reasons we've already discussed. They just don't make that many sales, and this gives you the sales, the total asset turnover is the sales per dollar of assets, and it's much lower for Tiffany's than it is for Kroger. Kroger churns through its assets. And then, of course, the equity multiplier is the big difference. Notice that return on asset wise, Tiffany's and Kroger's are fairly close together in most years. All right, most years. However, the high amount of financial leverage at Kroger, that's the real difference between these two companies. And Kroger can afford to use higher financial leverage because it's in the grocery store business. That's a relatively safe business. Over here at Tiffanys, they're in the jewelry business, high-end luxury jewelry. That's a much riskier business to begin with, so they can't afford to take on as much financial risk as measured by the equity multiplier.